Today we're going to talk a little bit more about risk management. Risk management is really the business that we're in. When you think about it, we're in the insurance business because what we're doing is we're collecting premium, we're collecting theta from other traders who are taking directional bets. So our business is really just the guy who manages the risks, and we have actually a lot more freedom than market makers or specialists on the floors do because we get to take the trades that we want and at the price we want. So in today's video, what I'd like to talk about is risk management, specifically risk management as it applies to our business. Any business is going to have risk. And I mentioned in the previous videos the four main risks that you have, plus price. Price obviously is a risk because that's what makes the markets go up and down. People have different opinions of price. They trade accordingly, and whether they win or lose, that's what makes a market. So what I like to do today is talk about risk management. And that means that you have to think about your portfolio. I'd rather have you in the mindset of being a manager of your business, your trading business, and the thing that you're managing is the risk. Really, any business is going to manage risk because if you go to a bakery or if you go to a gift shop or you go to any kind of business is going to have risk. So, for example, a bakery. Let's take that just for an example. You go to a bakery, they have cakes, they have cookies, they have all kinds of baked goods, right? Muffins and cinnamon donuts or cinnamon rolls. What is probably, if it's a big bakery, okay, even if it's a small bakery, but if it's a bakery, what do you think their primary risk is? Their primary risk, and I don't know anything about bakeries, but I'm just guessing here. So if you have a bakery and you know what the exact risks are, email me, let me know. But what I'm just saying is, because I don't know anything about it, but to me, just looking at a bakery, I would say the risk is the purchase of wheat or flour. See, I don't know anything about bakeries. Flour, butter, eggs, those commodities that they need in order to make their product. That's the big risk to them. The bigger the bakery, the more flour they're going to need, the more eggs they're going to need, the more butter or margarine or whatever they use. Those are risks that they need to manage. Now, a lot of the times they can pass on those costs. But what happens if, for example, flour prices and wheat prices have really skyrocketed, in the last few months? Now their costs are so much higher. But there's only a little bit of price movement maybe that they have in their product themselves when they sell it to the consumer after their labor costs, after electric, utility costs, and their raw materials, which is the flour, eggs, and butter. They don't have a lot of control over a lot of their business. And also they don't have they can fluctuate their prices. Yeah, when their costs go up, yeah, maybe they can raise the price of some of their products, a little bit. And I think the consumer would probably still, purchase in a certain range. But once the prices got above that range, they're going to see a dramatic cut in their sales, because if prices go a little bit high, people are going to start looking around for alternatives, and they may end up going someplace else. So, their risk is the raw material costs. Now, they also have labor costs. I mean, labor costs are also a risk. And those are even harder to manage. I mean, flour, eggs, and butter is probably one of their main costs and one of the risks of their business, because if those basic commodities rise in price dramatically, then they're going to be in a position where it's really going to cut down on their profit margin. In fact, they may even lose money. So how do they manage those risks? Well, a lot of times what they can do is they can purchase ahead of time. They can place their orders now for a certain price to be delivered at a future date at the price today. So if they think flour or eggs or butter is going up in the next 90 days, they might place a large order today at a fixed price so that they don't have to pay the prices 90 days from now, which may be a lot higher. But it also ties up more of their capital. And they also have storage costs. They got to keep this stuff someplace, right? So they're buying a large order now that would last them for several months. They have storage costs, they have additional costs, even though they think that they're buying it at a lower cost, but they have other costs associated with holding that commodity for a long period of time. So those are the kind of risk that a bakery would have. Every business has. My point is that every business has risk. It doesn't matter what kind of business it is. So the primary risk of our business, as I mentioned, there were 4 of those. And one of those really has to do with the allocation of capital. So in this particular trade, now we're getting down towards crunch time in our positions. We are actually less than 5 days away from expiration. Let's just take any symbol here, and you can see here that we've got, counting today, they have 6 days to the last trading day. When we get to Monday, we will have 4 days before the last trading day. Today is a Saturday, so we're doing this over the weekend. And our primary risk going into expiration is the fact that the price can move dramatically against us, right? And then wipe out our potential profits that we've accumulated. Let's take a look at a second. I want you to block out these QQQs just for a second. Because our primary position was the diamonds, the EEM, the IWM, and the SPY. Okay, those were our 4 main positions. I added this QQQs, and I'll tell you exactly. The whole point of this video is those QQQs. So I will talk about those. But our primary position was the diamond, EEM, IWM, and the SPY. Now the diamonds, we've got an open profit of $177. Our EEM isn't quite doing as well. However, the Theta has increased dramatically, and that was a little bit of a difficult position to manage. We're only up $13 on that, but we do have a small profit. Our IWM position is up $228, and our SPY position is profitable at $370. So our total open profit here, if we take a look at this column, our total open profit on our portfolio for this month is $783.50. Now remember, we're only doing like 1 or 2 contracts on these, so there's very, very small positions. And I will tell you again, you want to do very small positions, or you want to paper trade. Now paper trading has its place. I would do paper trading for several months if I were you, doing 1 or 2 contracts. I know it's really boring. It's not exciting at all, but good. That's good. Boring is good. Because you want to develop the skill set that you need in order to manage your business. So if you manage your business in paper first, doing 1 or 2 contracts, paper trading, and then going to live trading with only 1 or 2 contracts on each of these types of positions, you're going to be in a better place because you have the skills. And what we're trying to do is develop the skills in you.